In this video, I'm going to share with you guys the 5 benefits of trading the micro futures contract. Stay tuned. Hey, welcome back traders. So if you're not a futures trader, you're going to want to watch this video. If you do trade the futures market, you're going to want to watch this video. Now, before we get into the benefits that I see of trading the micro futures contract, please do me a favor, hit the subscribe button below, and don't forget to turn on the bell notification so you guys don't miss my next video. All right, so the micro futures contract. And in this video, we're going to talk about the ES, or the S&P 500 futures contract. And what the micro contract is it's 1/10 the value of the ES. Now, why is this beneficial? Well, this is going to bring us right into benefit number 1. All right, benefit number 1 are margins. All right, so what are margins, you may ask? Well, margin is the amount of money that it takes you to put on the trade. So here's a real quick rundown of what the margins look like. So to day trade the S&P 500, the ES futures contract, the E-mini contract that we've normally traded for many of years, the intraday margin on that is $500. Intraday meaning we're going to open and close that trade in the same day. All right. Now, with the introduction of the micro futures contract, which we can see right down here, the micro S&P 500, you only need $50 to initiate the position. Now, that's how much margin you're going to need to open the position. And that's as long as you're going to open and close the position in the same day. Now, if you want to hold this position overnight, you want to make sure you have at least $693 in the account plus, whatever amount of wiggle room you're going to have for your stop loss. If you want to hold the normal ES contract, that's going to be about $6,930 to hold that futures contract overnight. Now, this is going to bring me into reason number 2, or benefit number 2 of trading the micro futures contract. And for this, we're going to bring over the calculator. And actually, before I do that, take a look at these charts. The chart on the left is the MES, which is the micro futures contract. The chart on the right is the ES, which is what we have typically traded in the past. Now, one thing I want you guys to note, just so you guys can see, very similar. If we go from high to low, this is roughly 66 points in the S&P, and this is from Friday. And you're going to see this is 66.75, and that's probably just because how I measured it. So they're very, very similar in terms of, how they move, the price movement, the ATRs and such. So if you have a small trading account, this is going to be hugely beneficial. And here's how it's going to work out. We're going to use this for the calculator. Let's say that you're going to trade on the 5-minute chart. So we're switch this over to the 5-minute chart real quick. And I just want to give you guys an example, right? Both charts on the 5-minute chart, and you can see both charts look identical. Well, the chart on the right, let's just assume, and this is an assumption, this isn't, hey, this is where we would trade or not, but let's assume we're going to play a breakout of this candle right here. Well, a normal stop loss, we're probably going to have it 1 tick or so below the low. In this case, that would be a 7-point stop loss. All right, so on the E-mini ES contract that we normally would trade, that 7 points would represent $50 per point, would represent a $350 risk on the trade. So let me just go ahead and type that in real quick. All right, so that would represent $350 of risk. Now, we're going to come over and use that same example on the micro contract, right? So from here down to a low, went a little bit further on that one, just right? All right, that same example on the micro contract is going to be $5 per point. So in this example, we would go 7 times 5. We'd only have $35 of risk. We'd only have $35 of risk. So from a standpoint, if you have a small trading account, and I advocate that I like to trade 1 or 2% risk per trade. Well, if you have a small account size, it's going to be very difficult to take advantage of this trading opportunity in a small account. Now let's assume that you have a $2,000 trading account. All right, and we want to adhere to a 2% or a 1% risk per trade. Let's just see what that would look like initially. All right, so 2,000. Oops, a little too many zeros. 2,000, and we're going to times that by 0.01. All right, so that says we're allowed to risk $20 per trade. Well, in this example, this is way far away from $20. This one's a little bit closer. Well, let's say your risk tolerance is 2% per trade. All right, we're going to times this by 0.02, and you could risk $40 per trade. So if you have a little bit more higher risk tolerance, you could definitely take advantage of this opportunity, where this one, we're not even in the ballpark. On this one, on that same $2,000 account, we would be risking 350 divided by, you'd be risking 17.5% per trade. And that would be catastrophic. That would be, one of the reasons a lot of new traders blow up their account. They're risking too much on any one individual trade. So if you have a smaller account size, this is going to be much more conducive for you to actually adhere to proper risk management. This is going to bring us to reason number 3. All right, reason number 3, we can have better risk management, which is kind of what we just talked about in that last slide. And what I mean by this is, let's say for instance, let me remove this. Let's say for instance, you want to be able to take advantage of some of these moves. And even if you have a larger account, all right, let's say you want to do a breakout, but you want to have an opportunity to add. Well, in this account, you're going to be exponentially increasing your risk. Meaning on this account right here, each per contract, each tick equals $12.50. On this contract over here, the MES, the micro contract, each tick is only going to equal $1.25. So if you want to scale in or scale out of a position, the micro contract is going to give you a lot more flexibility than the big contract, because if you have a $10,000 account, let's even do the numbers with a $10,000 account. Pull the calculator over, we'll clear it out. On a $10,000 account, we're going to times that, and we're going to use 2%. All right. Ooh, that definitely wasn't right. I didn't hit times, but 10,000 times 0.02, we can risk $200 per trade. So if you want to take on 3 or 4 contracts, let's say 4 contracts, that means you can only risk 1 point per trade. And in the volatile environment that we're in now, that would be very difficult to put on good trading opportunities. But if we want to put on 4 micro contracts, we can still get that same advantage of scaling in and scaling out and having much better risk parameters per trade. Reason number 4, all right, or benefit number 4, that is going to be liquidity. All right. So the first week of trading on this micro contract on a 5-minute chart, if we were to look at some of the volumes, 8,000 contracts traded, around 12 o'clock. Obviously, the New York session is going to be a lot more volume since this is a US based product. All right. But there's plenty of liquidity to enter and exit a trade unless you have an enormously large account, in which case you want to trade the normal ES product or even the larger S&P contract. Now, if we compare this to, let's say, dollar Canada, and I know we're going to be looking at tick volume, but if we look at, let's say, dollar Canada, and that product's been traded forever in the Forex market, right around that same height, right, that same time period in New York session, the highest we had was 4,000 for the volume. So the micro contract on the first week of trading is already, spiking up to 8,000 contracts in a 5-minute bar. So there's plenty of liquidity to enter and exit the trade. And this is going to bring us to benefit number 5. All right. So number 5, we're going to compare this to, let's say, the euro dollar. And the benefit it's going to be is the opportunity or the daily range in the market. Let me remove this. We're going to put them both on a 60-minute chart. And the reason I'm doing so, I'm just trying to, just so we can see the actual day. And let me go back to the 9th on this one. It wasn't connected to my Forex data prior. So we're going to look at this day right here, May 9th, and May 9th over here. And in Forex, we look in terms of pips. So I'm going to adjust this real quick. All right, that's 76 pips in the euro dollar. Well, if we look at the micro futures contract, you might say, well, that's 50 points. But each point equals right? There's 4 ticks per point. So let's actually look at what this actually looks like, right? Each pip is 70, this is 76 pips, 76 and a half. Well, if we go 50.25 times 4, because there's 4 ticks in a point, our opportunity is 201 ticks within this trading session right here. And you may say, well, Mike, you just cherry picked one particular day or even a Forex pair. So let's jump over to another Forex pair real quick. We'll go to the pound dollar on May 9th. Pound dollar from high to low is roughly 69 pips. Still well below the 200 opportunity that we had on the micro futures contract. Now let's go to the pound yen. That tends to be a little bit of a bigger mover in the Forex market. Pound yen, we look from high to low, and that's just over 102 pips on this particular day. Now, the opportunity in that, meaning I don't think we're going to capture the whole move in the pound yen or in the micro futures contract. However, if we're trying to capture 10% of the daily range, right? That's a much more obtainable number, I would think. 201 times 0.10 would be 20 ticks, all right? 20 ticks in the micro futures contract is going to 1.25. It's going to be roughly $25. Not a whole lot of money, but as you build your account, you can always increase your position size. Now, the same thing if we're only trying to take 10% out of the pound yen, and let's say we're trading this with a mini contract, and I'm just going to use a generic version that it's $1 a pip, and I'm pretty sure it's a little bit different than that, but we're going to use $1 a pip for the example, right? 102.7 times 0.10, that's only going to be 10 pips of opportunity, or roughly $10 of opportunity. So as you can see, there's a huge benefit to trade in the micro futures contract, especially if you have a small account size. So if you guys agree with me, leave a comment below. If you disagree with me, leave a comment below and let me know. Until next time, guys, good luck and good trading.